I thought I have the honor of being the leader of this little discussion, but I'm sure people in the audience have a lot of things you would like to ask about and hear from our esteemed laureates as well. So I'm gonna leave time for your questions as well. So anyway, I had the pleasure of working quite a bit on this year's prize, preparing the scientific materials and so on. And part of it turned out to be economic history, because going through there's JSTOR databases and trying to read, okay, what did people actually think about banking and financial aspects of macro and so forth in the 50s, 60s, 70s before your work came around. Now, one thing that I find sort of fascinating is that, well, Doug and Phil, you worked together, and Ben, you were doing your thing sort of separately on similar issues. It felt almost like something was in the air at the time. So I want to start maybe just asking you how come you started thinking and working on these things at this time? Maybe I'll start with you, Ben.
Sure. So it was a very fortuitous junction of different schools of thought. In the graduate school at MIT, I was doing money and macro and so on. I was very interested in the Great Depression. I always had been, although I didn't include that in my dissertation. But I was thinking about, what were the causes. This was before the gold standard literature came in, and I was trying to think about that. And fortunately for me, my first job was at Stanford Business School, and Stanford was among the leaders in asymmetric information, principal agent models, and so on. And
Robert Wilson had a lot.
Robert Wilson, who is and Paul Milgram, who are both laureates, and David Krebs and John Roberts and others as well. And for me, it was a very fortunate juxtaposition, because I got introduced to this principal agent approach to corporate finance and so on. And I was just thinking about how that would relate to history, because I always approach these things from the historical perspective. And I wrote this paper. I was 29 or whatever. I can hardly.
How many years were you out of grad school when you started?
Well, I was out of grad school. I left grad school in how old was I? Anyway, I was only like a year out of grad school, and I had been in fact working on depression type issues in grad school. It wasn't in my dissertation, as I said, but anyway, this just was a very fortuitous combination. And I sort of wrote the paper as kind of a think piece, and I think what, from the perspective of today, it's a very primitive piece of work, but it did lead me and Mark Gertler and Simon Gilchrist and Nobuo Kiyotaki and Oliver Hart and other people to work on these issues of financial frictions and how even in, you can look at this in a crisis context, which is where I started, but even in looking at more normal business cycle fluctuations or monetary policy actions and so on, it's a useful addition, I think, to the macro framework.
So when you, because I know also you had like a little piece in the AER papers and proceedings too, which is not about the depression, but more like, okay, let's think about finance and macro. So was this sort of because now I think it's a bit hard to understand how radical it actually was, but I guess did you kind of encounter a lot of resistance or skepticism?
I did. You're right. It does seem a little strange, although if you look at even today, if you look at mainstream models, Keynesian or real business cycle models, they don't have very much of a financial sector. And I can tell you from experience that the Federal Reserve's FERBUS model, which is a very elaborate macro model, it has interest rates, of course, and stock prices and so on, but it doesn't have any room for financial crisis. And it consistently predicted the unemployment rate.
There were no intermediary in between in the model.
That's right. And actually, George Akerlof wrote a piece about how macro evolved sort of without putting finance, central. There are other schools, that have a more central role for finance, but the standard ones that were the ones I learned in graduate school had very little. And I remember an early seminar presentation when I got just people just pushed back and said, the financial sector just tells you who owns what.
Yeah.
That's all you need to know.
Yeah.
So anyway, so I think maybe Paul Milgram understood it, but I think most macroeconomists didn't really appreciate the perspective from imperfect information.
And I'm going to ask the same question to Doug and Phil here. You can answer each, but I know you also started working together quite early out of grad school. And
actually, in graduate school, actually in college, I got first exposed to this. There's a wonderful book by Milton Friedman and Anna Schwartz called The Monetary History of the United States. It's about this thick, and about this much of it is about the 1930s, late 1920s and 1930s.
It's on Kindle now, by the way.
Oh, it is. Okay. So now it's only this thick, but and I think when you buy the bound edition, it's around $100 right now. So you probably should get the Kindle version. But it's a wonderful book. And I had a course in Jerome Stein at Brown University taught an entire semester course just on this one economic history book. And I mean, unless you're in the right mood, it's a very boring book. The interest rate went up, the gold flowed in, the gold flowed out, and the banks failed. But a lot of it was about the 1930s and the bank failure and Milton Friedman and Anna Schwartz's diagnosis that it was the problem of the Federal Reserve being expected to have lent as a lender of last resort, which is why they're central banks in the first place. And they didn't do it because they thought the stock market was a bit too high, and they dealt with that very effectively, got it much too low. And so they stopped. They didn't encourage the banks to do more lending for speculative purposes. And they weren't lending. And then when the bank runs when people got concerned about the solvency of the banks weren't able to borrow from the Federal Reserve, and the runs got worse and worse and worse. And then we got into the thing that Phil and I ended up modeling of sort of thinking about why runs can be caused by the fear of runs, the fear of fear itself. And then you can cause banks to fail for no particular reason except people thought the banks were going to fail. So that was something that got me interested in this area in college.
So it was basically because a professor decided to do a course on Friedman and Schwartz.
Friedman and Schwartz, and made us read the whole book and think about exactly. We had to write an exam on how would the Great Depression have been different if they'd listened to some recommendation that Arthur Oken had about they should have pegged the interest rate or something like that. And then would that have fixed things or not? So that got me interested. Actually, it got me interested in doing the microeconomics of why people hold money. I read from this book. I thought the banks are interesting, but the money part was interesting. Then I got to graduate school and learned what that field actually was. And it was beyond the state of the art. It was a total chaotic field, and it was a very unpractical field at that point. Later, Nobu Kiyotaki and Randy Wright actually figured out how to turn that into a field that it would not have.
Still pretty complicated.
It's a very but then in the kinds of models I build, I didn't actually do the money part, but the reasons that people hold money in a model there wasn't any actual currency floating around. So I wrote in my dissertation, I wrote something about why banks have so much leverage and why they have to be big and diversified. It was not about the crisis kind of stuff, but because my advisors at the very beginning of graduate school were James Tobin and Martin Shubik, and both of them made clear in their own work and in their teaching that the financial sector was basically not modeled at all in mainstream economics. Monetary economics had this special little subfield that maybe up until about 20 years before that thought seriously about what banks did. As Ben just mentioned, macroeconomics and monetary economics almost didn't have any money and certainly no banking in that.
It's sort of interesting because when you read, Friedman Schwartz, it's incredibly, because you both were, all of you were influenced by it, and they describe bank runs in some detail and so on. But then when you read Friedman afterwards, he's sort of, we should just have, narrow banks that hold. So there's nothing about that.
Right. So the goal of the paper with Phil and the goal of paper by myself is to show there's actually something good about having this middleman, this intermediary between the ultimate sources of funds and the ultimate users of funds. And they do something. So Milton Friedman, there was the Chicago, as a University of Chicago person, I'm a bit embarrassed. The Chicago plan of making it illegal for banks to lend money out. It's called 100% reserve banking. So if you think banks are just a source of problems and no good, and you realize that the problem is they lend money out and they can't get it back during a run, just say, okay, don't let them lend the money out. Take all the money and put it in the central bank and let them allocate the credit. They didn't add that little part. That's my snide comment on what's wrong with that. So Phil and I wrote this paper on bank runs. So the second or third place we presented it was at the University of Pennsylvania. And someone who will remain, even because I used to misremember who it was, and the person who did it is actually a friend of mine, so I won't mention the person's name. So this should actually be in the economic history seminar, because we figured a long time ago to figure out how to deal with financial crises. So as we wrote this paper in 1981. It appeared in 1983. At that point, it was sort of a period of calm. So there hadn't been a lot of financial crises recently, partly because the regulators still remembered the Great Depression sufficiently recently. So we presented the paper, and then there was actually the day I went down to the University of Pennsylvania, some bank failed with a run somewhere in Connecticut. I think
in Hartford. It was in Hartford. I remember. I mean, Doug is the one who was presenting the seminar, and he read on the train about this bank failure. And I remember now some of the details because I was so impressed that he had such a great reply to their comment. It's like this bank was failing, and the bank president pointed at the medallion that says this. So you see this medallion here? That means that your deposits are insured. You don't have to worry about whether other people take out their money. If the bank did run out of money, the government's going to give you your money. You don't need to worry about whether too many other people are withdrawing, and to stop the run. And it was right there in the newspaper that morning.
And then about 3 months after our paper was published, the biggest bank run in the U.S. history, the Continental Illinois National Bank, occurred. So that was good. So we went from being a backwater of economic history into the front page. And then during Ben's professional career, it got onto the front page for several months.
Exactly. Fantastic. Now people realize how important our research is.
Bad times have been very, very good to us.
So, and you came out at this from a different angle, I guess, because you had been working on thinking about multiple equilibria, as you explained.
So I'm kind of a general theorist. I think it's because I have a short attention span. I work in different areas on every paper, and more or less. And the good thing about that, you can't point to anything where I milked an idea to write 4 papers. because it's always something new. But I was really intrigued by banks when Doug started talking about it.
But you were not the same cohort, right? In grad school,
I kind of didn't have a cohort at Yale because I was a first-year student at Penn, and I'd hooked up with Steve Ross actually when I was an undergraduate. In the U.S. on April 15th is the date you have to tell graduate schools where you're going, and Steve came to talk at Indiana on the 14th. And he gave a seminar, and I asked a question that was better than it deserved to be. He's going, and Steve is one of these guys who thinks there's the East Coast and the West Coast, and there's nothing in between. And it's like, here's this long-haired kid in the middle of nowhere who actually asked a good question. And it was something where it was the incentive signaling paper, and I thought it was safe to ask, how does it differ from the traditional story? Because I couldn't get traction from looking at his past papers. And I asked a friend who's an accounting major, what does it mean that if a firm has really high leverage? And she said it might indicate problems. Maybe they'll have trouble with cash flows. They're getting, they're having trouble staying in business. And Steve model, it's a macho thing.
Exactly.
It's like I take on lots of debt to show I'm really good and I can take it.
Yeah, exactly.
And so that's
That's what the private equity guys tell me.
and that's actually yeah when they're raising money. But anyhow, I think that's a better question than I deserve because that's why it's a parable and you don't
Yeah,
take it literally. But anyway, he agreed at that point.
Mhm.
I told him where I had offers and what my
Yeah.
concerns are, and
Yeah.
he agreed to work with me if I went to Penn. And so I, went back the next day and said yes to Penn. But anyhow, he moved after a year to Yale. But because he'd promised me, Steve was like the most loyal person ever to his students and so nice. He also said all sorts of nice things about us that weren't true. It's really great to have an advisor like that.
Yeah.
But after
Had your back.
Yes.
yeah, but after my first year, I transferred up to Yale with him. So I was never, his first year of graduate school is when you meet everybody,
Yeah.
and that's why I say I didn't really have a cohort.
Yeah.
But Doug was ahead of me. He was close to finishing his thesis at that point, and I had another couple of years to go. So
And then you started working on this bank ideas together at some point.
Yeah, right
Yeah.
after we finished
Yeah.
graduate school.
yeah, the way I remember it, and Doug may remember differently, is that we were at a conference and ran into each other, and we said, "Let's go have a beer."
Yeah.
And Doug says, "I think there are a lot of opportunities for modeling things in banking, using game theory, which there wasn't kind of information economics yet. It was like that." Game theory was separate from economics pretty much at that point. It was starting to merge. There are things here and there, but but anyway, I said the only thing I've heard about in banking is bank runs. They talked about it in the macro, and I had written a bunch of papers on multiple equilibria that I talked about in my talk. And I said it seems like it's a multiple equilibrium problem. And if that's all we had, then it might have been okay paper. Wouldn't have been the successful paper that has Workharth's model of liquidity, the reason why you want to have banks, even though they're runs, what you can do in the policy. I mean, I mean, most of the main contributions weren't there, but
So how given that this was sort of all of your work was sort of a departure from how people have thought about it before, and you were quite young. I mean, you're junior guys.
Under 30.
Yeah, exactly. How hard was it to sort of get traction for hearing, or was it more like I have to convince people, and some senior people are sort of, oh no, I mean, you mentioned a little bit along.
I got it. It was a good publication. It was like the lead article in the
Yeah.
but I really did get a lot of pushback in seminars, and someone told me the financial sector is a veil.
Yeah.
It's just and that was a expression that was often used.
Yeah.
It's just simply just sort of a accounting device.
So did you feel at some point, oh, maybe I should work on something else, or did you know I'm going to show them kind of?
Well, I was working on a lot of things, and I owe a lot. I should really give Mark Gertler a lot of credit. I met him when I first moved to Stanford, and he was finishing up his PhD at Stanford, and we shared a house for a summer, and I loved working with him. And after I had written this kind of descriptive paper, we sat down and tried to figure out how to write it more formally, and it was just very, it just seemed very productive. And we, went from there.
And then you also parallel, I guess, because this came your work with Alan Blinder as well, I guess, came out of this. So on the empirical side.
And I think there's always been a sort of a debate, sort of a credit versus money debate in macro, and I didn't really mean to really take sides on that debate. I think, for example, the current view of the Great Depression is that the malfunctioning gold standard played an important role, and Friedman and Schwartz talked about banking crises, but they talked about mostly the effect on the money supply, not the effect on the credit. I'm willing to accept a world in which both of these things are important. In fact, they're interactive. So, for example, if a money contraction causes a big deflation, that's going to bankrupt, farmers who have commodity price, depend on commodity prices and fixed mortgage payments. So, I thought that was not that the credit versus money debate was not really a good way to frame it. And just understanding how both of these things interact was going to be a useful approach.
I guess that's we forget now we have some inflation. I guess that in some sense is good for solvency then. It's weird.
It is. It's good. I mean, don't quote me. I don't think inflation is good, but one of the things it does is reduce the burden of debt on people with nominal debt contracts.
I think you have a paper on that. No?
Yes,
very good.
Yes. A lot about transfers.
Yeah, exactly. But on your end, when you had the Diamond-Dybvig and your dissertation chapter, which was on banking, which I guess was not a huge field in finance at the time.
It wasn't in finance. There were very few schools that thought that banking was part of finance. And that, which I never understood. I mean, it's still the case that most schools don't think insurance is part of finance, which I don't get either.
We figured out banking is insurance, basically. So
exactly.
It's a common problem.
So how did you sort of feel that, it's hard to get people interested in this or get traction, or did you get like a lot of encouragement?
There really wasn't banking theory before that. People were trying to use like supply and demand to do banking, and they had to get curve shifting, or they had to put in transaction costs and things. So at the
production frontiers,
all this kind of stuff. That basically, my dissertation was sort of contract theory, and Diamond-Dybvig is sort of mechanism design. Those were sort of newish tools at that time. And in fact, to try to get some traction with this, most of the people who thought this paper wasn't total trash at the beginning, they were in the sort of the applied theory school, like Neil Wallace or Rob Townsend. They were some of the early advocates for it. And some of my colleagues at Chicago who were like Gene Fama, who was the banks are just a veil, and that you had to explain how it looked like they were doing things.
He has a paper with 100%, what do you call it?
100% reserve banking, and
coming out just a few years before, or about the time you got to Chicago.
And Fisher Black had written some things how banks don't do anything, but it turned out like Gene Fama, even though he had a paper saying they don't do anything, thought really seriously about this, because this was part of since it was part of an optimal mechanism. He knew that his belief was also the market somehow found a way to get to the market optimal mechanism, even if it needed contracts. So there was, and then fortunately in the paper with Phil, the Diamond-Dybvig paper, we sent that. I later found out who the referee was, John Carrican at the University of Minnesota. If there was any banking theorist before this, it was him. And he wrote some papers with Neil Carrican. So Neil Wallace and John Carrican wrote a classic paper on moral hazard in banking. So we got him as a referee. And he basically accepted in the first round, which is like an off the equilibrium path. It never happens, right? So then Michael Musa,
got the right equilibrium that time.
That's right. So and Michael Musa was trying to push us to the bad equilibrium. He was the editor. So we got a short, very positive referees report, which unfortunately I've lost. Maybe Phil has a copy, but I don't. I think
I think I finally cleaned out a lot of my files.
Me too.
I'm a pack rat.
Right.
I saw.
I might have kept these things. But like, who the heck is going to be interested in this, right? So
you have some rejections you can show.
If somebody told me that, I wouldn't have believed him anyway.
That's true. So, so basically, we had this report that sort of said, they explained sort of better than we did exactly what we did, and so that he recommended maybe we explain a little bit more to the economic history. But then Michael Musa made us say things like, I can't remember, it was something along the lines of, you say there's a role for government, but it's really taxation authority. That could be a private entity. I'm not trying to, the mafia maybe, or something like that. So,
as Doug used to say, private governments will work just as well as public governments.
But that was part of the Church of the University of Chicago at the time. Nothing good could come from the government, but I think we've turned the corner on that one.
But I guess, as you said, you had mentors like Stephen Ross who were sort of encouraging you.
I don't even remember talking to Steve about this paper because we're both out of graduate school. It's possible. It's quite, but but the influence is always
Yeah,
there.
yeah,
I mean,
yeah.
it permeates everything.
yeah,
we,
yeah.
Well, I remember
we
that
did.
we presented, I think we were both there. We presented at Yale.
Yeah.
I think you were working at, maybe you weren't there, but you were working at Princeton. I was working at Chicago. We presented at Yale, and then Steve completely got it.
Yeah.
And
He usually did, no?
oh, he always got it. No, but he
Yeah.
completely got, this is going to be better than anything else we had written before. And
Yeah.
he didn't say subsequently, it probably was better than anything we
Yeah.
did subsequently as well. But Steve completely got that this was a nice paper. One, because, you know, the point is, it's not just the runs. It's like the runs are up to one little comma or something like that. They're part of the optimal mechanism.
Yeah.
And the other equilibrium, you get the first best optimal, so you can't do better. And he realized that that was an important part, and that's like what's wrong with 100% reserve. You know, getting rid of banks is not. It's
exactly.
you know, throwing out the baby with the bathwater, essentially. So.
Which I guess also with you know, you're saying, okay, it's not that the monetary story was irrelevant, but this might also have some bearing. I think these subtleties turn out to be quite important for policy, right? Because if you don't have the cost of financial
The way I thought about the financial crisis was that there were two big things to do. The first was to stabilize the system, which was a credit issue. And the second was to make sure that we didn't get deflation or, you know, to keep monetary policy very expansionary. And I didn't see any conflict between that at all.
But which actually comes to the interesting thing with your work, obviously, is not just that it's important from an academic point, but it's very policy relevant. And I guess you, Ben, you worked in policy for many years, but how receptive is sort of policy to take? I mean, when you were obviously at the Fed, it was easier to incorporate some insights into policy since you were there. But just in general, how easy is it to affect policymaker and their thinking, or should we be doing that more or less? Or
I can hardly exaggerate how fragmented and irrational and incomplete the financial regulatory system was prior to the financial crisis. The way the U.S. constructed its regulatory system was periodically there'd be some kind of problem, and they create a new agency to deal with that. And you know, and the union of those agencies left big gaps. And nobody was in charge of the system overall. So I think it's somewhat better now. And there's a council that tries to bring together, you know, all the different agencies. But I think still that there's big sections of the financial system which are inadequately supervised. And we saw that in March of 2020 when the treasury market and the shadow banking sector, I mean, it blew up, and the Fed had to do what it does in that kind of situation.
And crypto is the next one.
Well, you weren't here. We were just at a high school, and some kid asked about crypto, and Doug and I were competing, you know, trying to, you know,
Cash crypto.
cash crypto.
We can save you a lot of money. 2 Nobel laureates say stay away.
That probably means buy, you know.
Yeah, that's right. That's right.
my son forced me to buy some at the exactly wrong moment. So.
Okay.
For the right moment for educational purposes.
Yeah, exactly. See, you should have listened to me. I'm losing money, but you know, it's a lesson learned anyway. But did was this something that you try to sell or discuss with? I guess the deposit insurance was there, so it wasn't so controversial. But did you interact with or get some interest from policymakers of your work?
Yes, not immediately. Partly we were too young for them to think we knew anything. But I think like the FDIC, I'd sort of spent a bunch of time talking to people at the FDIC about how they would change their insurance. And then during the 2008 to 2007 to 9 financial crisis, the deposit insurance in the United States was raised from like 100,000 to infinity for checking accounts and to 250,000. And then various people in the Council of Economic Advisors and the Treasury asked for our advice
Yeah.
and, had a lot of meetings with them and phone calls.
Yeah.
Austin Goolsby, who was in the council at that point, was my colleague. So
Right.
I could tell him straight on, and he sort of realized I'm probably not making it up.
Yeah.
But they reduced it again.
They reduced it again. Yeah.
So
Infinity is a little too high.
Yeah.
well, I'm not sure.
good.
I'm not sure it is.
Yeah.
I mean, the thing is that the part of the deposits that are not insured can still run.
Yeah.
And if that's trivial, it's okay.
Mm.
But if it's not trivial, then that's an issue.
Yeah.
People talk about people running on the bank will provide discipline to the bank, and that what it does is it causes problems for the regulators.
You can
And they
fight
close
that
down
out
the
at
break.
some
Yeah, so
point.
I'm in the wishful thinking school. Rajan and I have written a bunch of papers that the runs are bad, the threat of a run is good, and essentially short-term debt is harder to renegotiate outside of bankruptcy than long-term debt. So that if you have short-term debt, you pretty much pay it if you can. There's all kinds of bad things from that, but there's a trade-off then between stability and commitment, essentially.
right.
So.
It's important not just that this doesn't just apply to commercial banks.
Yeah.
It applies to any
Exactly.
situation where you have short-term debt financing,
Right.
long-term or illiquid.
Right.
Exactly.
Yeah, so I like this story for investment banks, but I don't like it for
Yeah.
commercial
No,
banks.
no,
I just think
right.
we should do better
Yeah.
than that. I mean,
Right.
this to me is a kind of a desperate way to get incentives.
So in terms of you mentioned how would we sell our product? We're still getting a commission on this, so we'll sell a little more. So the banks in Diamond-Dybvig are not banks.
Yeah.
They are contracts where you issue short-term debt to finance long-term illiquid assets, and you don't need a commercial banking license. You only be able to pay your bills with
Yeah.
the stuff.
Yeah.
So we have models of shadow banks, of which banks were a special case.
Yeah.
So there weren't that many shadow banks at the time, but we've seen all in recent. I mean, Lehman Brothers was clearly a bank in our model.
Yeah. So I should see if open up the floor to the audience, just see if there's any questions. Yes, Paul, please. Oh, do we have a mic coming?
Okay, Mike.
Who is? Oh,
There's Mike. There's Mike.
Sorry, there we go.
Hello. Okay, good. Okay, so as I was listening to you. By the way, thank you. I enjoyed listening to your lectures too, and I'm still puzzling trying to understand some aspects of this. You guys are talking all about finance without comparing it to other inputs the firm got. We've just come through in the pandemic era where we've had supply disruptions. And I was asking myself as I was listening to you, why can't I think of finance as supply to a company which is being disrupted? We have other supply disruptions going on. You guys have explained the economics of banking, why banking is as it is, but transportation is as it is. Each industry has its own characteristics. Why do we care more about disruptions in finance than, say, in transportation or other inputs that are associated? It's just an honest question. I was trying to set in context the work that you were doing.
So I guess I would think that for the banking, we have an optimal contract in when people have preference for liquidity and you have illiquid assets. You have the optimal contract if you just set up as a demand deposit, which is motivated historically. That has this instability, and I don't know that the regular supply chain does have that stability. And I guess I'd have to think about that. Now we could probably get into. Now to me, there's actually a really good question is all the things that are in macro models and causing the problems are different from supply chain disruptions, and I think that probably the policy should be different.
We did have a
Supply
run
chain.
on toilet paper
Yes.
when COVID started.
Yeah. So, but that actually is kind of unstable because if you don't run, you actually get a lower price later.
Right.
So that is
Right.
I mean, it could be that you have uncertainty about how long how long the supply disruption will last. And then if you think other people are hoarding, you want to hoard. But there's some kind of economic forces there pushing you towards, well, if everybody's hoarded and now they're producing again, you'd be high on the demand curve and get a high price if you buy it now. You get a lower price if you buy it later. So
they ran into this in the United States, this chain Costco that sells lots of big. They stopped taking, they have a thing where you can take something and get your money back at full price. So they had particularly severe runs at Costco because you could buy lots of it and then get it back. So they suspended their return policy on toilet paper, paper towels,
convertibility,
suspension of convertibility and full refundability. And it stopped the run at Costco. People rushed to return the paper because it was coming back next week or something like. So people got it back, and the inventory went. So they did better than the bank regulators here because they were in the free market sector.
But that's one analogy is the hoarding. So like in a financial crisis, firms that have credit lines draw those lines down maximum. One of the reasons it's so bad for investment and employment is that companies, even if they're not currently investing in a factory or something, if they think that the credit market is very bad, then they will hoard cash the same way people have hoarded toilet paper, and therefore be very cautious about hiring or investing or so on. So in some ways, it's similar to the supply chain issues, although maybe bigger. But what we saw in the big financial crisis like 2007, 2009 is the interactions. First of all, a toilet paper company, if they can't supply, they don't go out of business. But besides that, you see these interactions among these different firms, and they all have in common that unlike a seller of toilet paper, they have to gain information about their customer in order to solve the principal agent problem to get repaid. So I think there's some interesting analogies there, but I think finance is particularly prone to this sort of running and hoarding type phenomenon.
I mean, like the persistent persistent part of like if you let the financial system collapse, Ben mentioned it destroys the information. So evidence shows that where you could have made if the railroads or the airlines collapsed, the trains would still be there, the track would still be there. The restarting after a failure wouldn't be as difficult as restarting the financial system. And since the financial system is partly designed to deal with conflicts of interest between borrowers and lenders, it's very pervasive across the economy. Railroads are very pervasive, but it sort of affects the household sector because they've lost a lot of money if the banks fail. The small and medium businesses will have a hard time raising money. So the financial sector, like in a network, they're more in the center of a network. So bad things happen. But you do need transportation as well.
Guys, those were great answers, and they really helped me a lot. I do think that's one of the things we really need to emphasize when you're explaining why banking is important. You do want to contrast it with these other industries and explain what are the differences. And because when you said earlier that your friends at Chicago thought finance was just a veil, all the real transactions pass through, they're really asking you, why is it any different than anything else? And you guys were telling us about banking without comparing it and telling us why it's different. I think that's an important part of the story, and I think you just did